There's a question sophisticated investors ask that casual buyers never think about. What is the after-tax, risk-adjusted yield? Not, will this go up? Not, is this a good deal? When you start asking the right question, you stop seeing real estate as property and start seeing it as capital allocation. Today, I'm going to show you why Dubai real estate now functions as a distinct global asset class and what that actually means for your portfolio. An asset class isn't defined by what it is. It's defined by how it behaves. Institutional investors evaluate 4 metrics: yield, predictable income generation; appreciation, capital growth over time; liquidity, the speed and ease of exit; and risk profile, volatility, correlation, and downside protection. Equities give you growth, but with volatility. Bonds give you income, but with inflation erosion. Commodities give you diversification, but no yield. Real estate, when structured correctly, offers both income and appreciation, with lower correlation to traditional markets. But only certain real estate markets qualify. Dubai real estate doesn't behave like London, New York, or Singapore. And that's not marketing. It's structural design. Here's what makes it different: zero income tax, zero capital gains tax, a currency pegged to the US dollar, and a centralized land registry with mandatory escrow. Together, this removes the 2 largest drags on global real estate returns: tax leakage and currency risk. In most developed markets, a 6% gross yield becomes 3.5% after tax and currency adjustments. In Dubai, your 6% is your 6%. That structural advantage isn't temporary. It's systemic. Let's talk about yield. Not theoretically, but comparatively. Right now, institutional-grade residential assets in prime Dubai locations are delivering net yields between 5.5 and 7.5%. That's after service charges, maintenance, and management. Compare that to US 10-year treasuries, around 4.5%. Taxable. The S&P 500 dividend yield, under 2%. Prime London or Manhattan rental yields, 2 to 3% net, after taxes. Corporate bonds, 5 to 6%, with credit risk, and no upside. Suddenly, Dubai real estate starts looking less like property and more like a fixed income alternative with embedded capital appreciation. That's not hype, that's math. One of the biggest myths about real estate is illiquidity, and in many markets, that's true. But Dubai's secondary market has evolved rapidly over the past 5 years. Transactions close in weeks, not months. Title transfer is centralized and transparent. Mortgage availability supports buyer liquidity. This allows institutional and sophisticated investors to do 3 things: rebalance portfolios annually, scale positions without timing risk, and treat real estate as allocated capital, not locked equity. That liquidity premium is what separates an asset class from a long-term bet. Now here's the part most people get wrong. Not all Dubai real estate qualifies as an asset class investment. There's a difference between buying an asset and speculating on a story. Asset class thinking focuses on 5 fundamentals: location fundamentals, infrastructure, accessibility, and end-user demand; rental depth, proven occupancy and tenant quality; developer track record, delivery history and financial stability; exit optionality, resale precedent and buyer appetite. Speculation focuses on something else: entry point pricing, payment plans, and promised appreciation. One is a strategy, the other is a hope. And the market rewards strategy. At Jodoa Properties, we don't treat every investor the same, because no 2 portfolios are identical. Some clients need income, others need growth. Some need preservation with optionality. Our role isn't to sell property, It's to help you structure exposure to Dubai real estate the same way you would structure exposure to any asset class, with clarity on risk, with alignment on objective, and with discipline on execution. Because once you start thinking in terms of allocation, not acquisition, everything changes.
Dubai real estate has crossed the threshold. It's no longer just a location play. It's a capital allocation decision with measurable yield, liquidity, and risk. If you're evaluating Dubai not because it's exciting, but because the numbers make sense, then you're asking the right question. Subscribe for more institutional-grade breakdowns. And if you want to explore Dubai real estate as part of a structured portfolio strategy, reach out to Jodoa Properties.